Okay. Okay, I have done the most important thing. So yeah, welcome. I'll dive in. There might be some late joiners, but we'll get started. So I'm gonna share my screen in just a moment. But first of all, I wanted to ask, just get a sense of, who's here, why you're here. So if you don't mind in the chat sharing, are you a business owner? Are you incorporated? Are you self-employed? Are you here just mainly to learn? I know we have lots of people who are here learning because they are newer agents in our agency. They're learning, they're getting their financial licenses right now, and they want to learn these strategies too. So we have some people here just to learn. And then, yeah, people who are thinking about incorporating. Let me just see what we got in the chat. Yeah, learning. Okay. Okay, good to know the volume's too loud. I will note that for next time. Yep, a couple of people have a corp. Okay, awesome. So let me get my screen shared here for you and we'll dive right into the content today. And let's see. Okay, share this up here, present. All right, hopefully you can see that. And if you have, can put a thumbs up in your camera. That's always helpful for me. All right, business owner, self-employed, learning, planning to incorporate next year. Also own and incorporate small business. Oh, awesome. Okay, great. So I'm gonna try to keep my eye on the chat. Um, but that is sometimes challenging when you've got different screens and cameras and all these things to look at. So if I could make a request, if you have questions and you want to throw them in the chat, please feel free to do that so that you get them out of your brain while you're thinking about it. I probably will not address questions until the end, and we'll see. I can answer maybe some general questions. But most important, really, if you like what you hear today, and if you're curious, and if you need more details and specifics, the best thing would be to reach back out to whomever invited you to this webinar, because chances are they are getting licensed or they are licensed to do the same work here that I do. So they would be the one to be able to support you. Today, we're going to talk about how to use your corporate or your business revenue to grow your wealth while minimizing taxation and protecting your income and protecting your family. And really about how we can set up some strategies that can do all of these things for you, as well as create a legacy, which is pretty freaking cool. So a little disclaimer to start us off here. This is for educational purposes and it should not be taken as advice. We cannot provide advice on your situation without knowing your situation. So it's not about, taking what I say today and running off and trying to do that. It's about getting, further information, further education and advice that's tailored to you and your situation. We can never guarantee any specific outcomes or returns, especially in the financial world. I'm going to show a case study, some examples today, but I just want you to know that, these are projections, right? And as I mentioned, please contact the person who invited you to the webinar for more information. So who am I? Quick introduction before I get into the meat and potatoes. And why am I talking about this? So my husband has had an incorporated business for over a decade. I have been working alongside him in that business for the better part of that decade. And we couldn't believe that there were some things we didn't know about what we could do with our corporation and with the cash flow in our business until 2021. So the reason that I started to learn these things is because we had our first child in 2020. I was really motivated to just to get my finances and our finances in a much better spot. When we became parents, all of a sudden there was a little extra incentive. And through that process, we were able to learn a lot about some strategies that exist that the banks, no one had ever, no one ever had mentioned it to us. So I wish I'd known about it sooner. I wish we had put some of these things in place sooner, but I'm sure glad that we did when we did. And now we're, 4 or 5 years into our plans here. We, like many business owners, were affected during the pandemic. We had to close our doors. for a period of time. And then we were just unsure as to how stable the future of our business would be. So getting in place financial strategies that kind of give you some safety nets, give you some peace of mind, that was really important to us. And then it was also important to us that we had alternative streams of income. So I decided to get licensed to do this work as a financial broker and an insurance agent. The agency that we did that through was WFG, and many of the people here today to learn are also aligned with our team and agency. And what I love about WFG is that it's an agency that allows us to broker with different financial institutions and insurance companies across Canada. So we're not limited to offering our clients just one product or one, type of solution. We can really shop around and investigate the options that will best serve our clients. And over the past 4 years, I've supported hundreds of clients, and many, many of those have been incorporated business owners. So we've taken the experience, our personal experience, and I've brought that to other people who are in a similar situation. So it's an area of particular interest for me. So today I'm going to cover a few things here. The first quick thing is the 3 professionals that you need to have on your team if you are incorporated or thinking about incorporating your business. 3 unique advantages that are available when you incorporate that you don't necessarily have if you stay as a sole proprietor. And then a quick little blurb I have on when to incorporate. If you're like, okay, I feel like maybe I should soon, I'm not sure when, how do I make that decision? We'll then get into a little bit about the strategy of how we can use corporate cash flow to plan for retirement, to grow our wealth, to invest in a tax sheltered way. And I will touch on the infinite banking concept. Some of you may have heard that term. So I will give you a little explanation as to what that is. And it does fit exactly into the strategy that we're talking about today. And I also just want to mention that what we're going to talk about today, it's possible to do even if you don't incorporate or you're not incorporated and you never do incorporate. You can still take advantage of some of the things I'm going to talk about. It's just that when you're incorporated, you turbocharge the results that you can experience here. So I'll explain that as we go. Okay, you need to have a few professionals on your team if you are going to incorporate a business. We probably would all think of an accountant. We'd be like, okay, yeah, that's important. When you incorporate, you're going to have to file not only your personal taxes, but you're going to have to file a corporate tax return each year. And definitely finding a good accountant would be an important step to take. And then we also have the idea of working with a corporate lawyer. So you can incorporate through some online methods these days. So you can set up a corporation without working with a lawyer. But it is recommended to work with professionals. They are going to be in a better position to advise you on your situation. And especially if you have plans of building, an empire, businesses, investments, all sorts of things, and you might want to design a corporate structure that will fulfill that vision. And then you also have to do some annual reports for your company. So a lawyer can help you do that. But what is the third professional? This is the one that a lot of people miss. And this is where we were at. We had that accountant, we had that lawyer, but no one had ever sat down with us and applied financial strategy to our corporation. So the third professional that you should really have, and I would argue that everyone should have one of these people, whether you're incorporated or not, is a financial advisor or someone who can apply some financial strategy to your business and your personal life. And that's where we come in. So myself as a licensed broker and many of the people on this screen are also licensed advisors. So let's get into some of the benefits of incorporating your business. And there are many, and some of them are more in the realm of like legal benefits, protection from that sort of thing, which, you may need to investigate depending what type of business you're in. But from a purely financial standpoint, these are some of the top benefits that you will potentially experience if you incorporate. I'll go into each of these. So tax deferral, income splitting and paying yourself through dividends, and utilizing an 89-cent dollar. And that's where some people raise their eyebrows. They're like, what do you mean an 89-cent dollar? Well, let me explain what I mean. So these are corporate tax rates in Canada. I just looked these up, so they are current as of 2025, 2026. And what you're seeing on the screen here is by province, the combined tax rates, so federal and provincial combined. And there's two columns. One is for your active business income up to 500,000, which is considered the small business threshold. It is slightly different in some provinces. I think one or two provinces are 600,000, but most of them are 500,000. And then you have a combined tax rate on your income above 500,000, obviously a higher rate. So as you can see, quite a few of the provinces are in the range of 11 or 12%, 10 to 11, 12% taxation. So when I say an 89-cent dollar, I mean that if you have a dollar coming into your business, a profit, a dollar of profit, and you pay 11% tax, that leaves you with an 89-cent dollar. Okay, so think about the money that you earn personally. You are probably paying tax at the rate of, and it, makes me sad and depressed to say it out loud, but 30%, 40%, up in that range, even moving towards 50%, depending on what your personal marginal tax rates are. So is this an advantage to have a dollar that is actually ends up being worth 89 cents after taxes? It is for sure, because a personal dollar after taxes is usually more like 60 cents. So keeping that in mind, and yes, some provinces are even lower than that, but 11% is a pretty good average for us to work with. So let's talk about the first one, tax deferral. What does this mean? So if you are a sole proprietor, you are self-employed. You make money and you get to deduct your business expenses and then you pay tax on whatever income you have after that. You are going to pay taxes on all of your income, like after expenses. All of your income is taxable in the year that you earn it. If you create a corporation, you are now in control of when you pull money out of the corporation to pay yourself personally. And therefore, you can control how much personal taxes you pay, which is quite different than being a self-employed sole proprietor. When you're a sole proprietor, all your income taxable. Corporation, you now create a separate entity. The corporation is going to have its own tax situation, but when you pay yourself as an individual, you're in control of how much you pay yourself, when you pay yourself, and thus when you pay personal taxes. This is important because a lot of businesses experience fluctuations in their revenue and income. You might have really good, really busy seasons and then slower seasons. You might have busy months, slower months, weeks, whatever that looks like for you, especially things like if you're an incorporated realtor, like having a prep, or you just have a business that is very seasonal in nature. You want to potentially be in control of when your money hits your personal bank account and therefore when you pay taxes, right? So this little image is just showing that your revenue might fluctuate, but you can kind of decide when and how much you pull out of your corporation to cover your living expenses. And you can, if you're smart, keep that as low as possible so that you're not paying extra taxes on money that you don't need to use personally. This is a strategy that we for sure use in our business, and it is a matter of reverse engineering our monthly expenses that we have to pay for personal, which is our housing and our childcare and our groceries and all that. And just figuring out, okay, what do we need? What's the bare minimum that we need for our lifestyle? And that's what we take out of the corporation. And anything extra, we leave it there. And then you're only paying 11% tax on that. Now, when should you incorporate if you haven't incorporated already? Here is my little tip. Now, this isn't a hard and fast rule. Again, you need to consult with the experts, the professionals for your situation, because there could be legal reasons to incorporate. There could be other reasons to incorporate. But in a nutshell, if you are taking out all of the income from your business for your personal lifestyle, so whatever it is that you're earning in a year, you need all that money. You need it to pay your mortgage, your bills, your groceries, whatever. Then there isn't a huge advantage financially to incorporating because you're kind of going to end up really at the end of the day paying the same amount of tax, whether you do it through corporate and dividends and salary and all that, or whether you just stay as a sole proprietor. At the end of the day, if you're using all that income, you're taking it all personally, you're going to pay roughly the same amount of tax. The point at which incorporation makes really good sense, in my opinion, is when you have more income in your business than what you need to live personally. So that means that you have surplus income that you can keep in the corporation, pay that lower tax rate. Hopefully that makes sense to everybody. Now, of course, like I said, there could be other reasons to incorporate, liability reasons, etc. Maybe a joint ownership of a business that you have other partners in. That type of stuff totally makes sense to incorporate. But purely from a financial standpoint, consider whether your business has extra income that you don't have to use personally at this point in time. So that's one of my little thresholds to think about. With that said, though, there are some implications around like Canada Pension Plan, which is a whole other can of worms I'm not going to open right now, but just definitely something to consider and have a conversation with one of us if that is something you're curious about. Because as a sole provider, you are paying fully into the Canada Pension Plan program. As an incorporated business owner, you can potentially choose to opt out of that. Okay, income splitting. I got to move quicker. I have so much to talk about. Okay, income splitting is the idea that you put your partner, if you have a partner, a spouse, that you can put them on as a shareholder in your company, and then you can split the income out of the business between the two of you, rather than just one person having a much higher personal income and therefore paying more personal taxes. You can also, if you have multiple shareholders, say you and your partner, you can choose how you pay yourself, either salary or dividends, or some combination of the two. And this is going back to my my business diploma and my accounting 101 classes that I took. Just really quickly, if you have revenue flowing into your corporation, if you pay yourself salary, it comes off as a business expense, and then your net income is what you pay your corporate tax rate on. If you choose to not pay yourself a salary, but to pay yourself dividends, then you're going to actually have higher income in your corporation that you pay the corporate tax rate on, but then the dividend income you pay yourself personally is at a slightly lower tax rate than salary. And the other thing about dividend income is that you can opt out of the Canada Pension Plan, and therefore the money that you would pay into that program, you could redirect and invest in a different way, which might make a lot of sense. So I am not a tax accountant. That's the extent of my tax little tutorial for you there. But I do think that's impactful to understand. Okay, number 3, utilizing an 89-cent dollar. What this means is after you have paid your business expenses and paid your corporate tax rate, your corporate taxes, you have roughly an 89-cent dollar depending on what province you live in. So $1 profit turns into 89 cents after taxes. Now, what can we do with that money if we don't need it, if we don't have to pull it out and pay our personal bills? We could pay ourselves an extra dividend or bonus or increase our salary, and that would result in more taxation. And then we could take that money and invest it in a TFSA, an RRSP, or a non-registered account that are personal investment accounts. But again, we're working with like a 60-cent dollar here. Or is there a better way? Could we do something with that 89-cent dollar that would be more efficient? And let me show you why some people don't do this in a second, because I've got some other tax rates to show you. But why would we invest our corporate dollars? Well, we have to think about the future. Business owners typically don't have pension plans, aside from what we build and set up ourselves. So we need to think about our future and how we're going to finance it. And potentially we want to opt out of this CPP program, and we want to set something up for ourselves that we're in more control of. We may want to build wealth and diversify our income streams, and we may want to build generational wealth. We may want to think about our legacy and how we're going to transfer wealth across, to our kids, grandkids, etc. These are reasons why we all want to invest, hopefully. But what happens if you invest inside of a corporation without knowing the strategies I'm about to show you? Passive investment income that I've got in the yellow box here is taxed at a very high rate inside of a corporation. So you can see that the active business income is that lovely, 10 or 11%. But if you invest inside your corporation, whether you get interest income, you have like rental properties or other types of passive income, you're going to be taxed in the ballpark of 45 to 50% on all of that investment growth. So that kind of sucks, and that eats into your ability to compound and grow your wealth. Okay, capital gains are at a lower rate, but again, still taxable. So can we invest in a corporation in a tax sheltered way? Yes, you can. It's called permanent life insurance, and it is the way to utilize that tax sheltering nature of your corporation and to get those dollars working harder for you. So permanent life insurance, if you are not familiar with it, comes in two different types. And this is very different than what many people have, which is term life insurance. Term life insurance is a cheap type of insurance, provides protection. If you pass away, there's a death benefit, but it has no cash value. It has no investment component. It is just simply a mitigation of risk, a protection against the worst case scenario. These two types of life insurance are considered an asset class in and of themselves. They actually build a cash value. They grow over time in value, and they can serve many different purposes. So we have two main types here, universal life and whole life. And they both have some pretty cool advantages and, different features that might make them the right choice for someone. Universal life is very, very flexible, and it has the ability for you to choose the investments inside the policy. So if you like stock market investing, you want to use some index funds, you want to see some really good rates of return, higher growth, and you want a complete flexibility around how much you put into the policy at any given time, universal life is probably the way to go. You can, design this in such a way so that you have a lot of wiggle room around how much you put in, minimums, maximums, etc. And the value, the investment account that is held within this policy is going to grow and compound completely tax-free. There is the ability with both of these types of policies that you can actually access and leverage the cash inside the policy if you want to, if you need to. I'll get more into that later. Whole life is a more of a set it and forget it, guaranteed growth, but slower growth typically. What we see over here is no market risk. So it's just a safe and steady progression of growth. You receive dividends inside of a whole life policy. The dividend scale is currently around 6 to 6.5%. But essentially, if you imagine this as a very, very safe place to stash your cash and to have it grow and compound over time. Meanwhile, you have a death benefit. So you have an insurance amount, which is always going to be significantly higher than the amount of money you've put in so far. And with whole life, because it's so secure and so low risk, you can borrow or leverage usually up to 90% of the cash value that you have there. So it's very accessible to you, which can be super helpful as a business owner if you need to, access some cash for some reason. And it can also be then used later down the road as financing retirement, both of these scenarios. So I'm not going to get any deeper into those two right now. I'm going to share a couple, an example here, just to give you an idea of what this could look like. Now, of course, very specific to each individual scenario, we're going to have to, assess what makes sense. We're going to design a plan that is, appropriate for your level of revenue, for your levels of how much you want to contribute. But in this case, we have an example of an incorporated professional, and they're taking salary out of the corporation. In this example, they have fully funded their TFSAs, which was an important place to also invest your money because TFSA, tax-free savings accounts, all of that investment growth is tax-free as well. But they have still got extra cash. So the corporation has retained earnings approximately $30,000 to $50,000 annually. So what can we do with that money? So one option would be to put in place a universal life insurance policy. let's just say that the amount of $1 million for insurance makes sense for this particular family. The corporation is going to own the policy and pay for the policy. So that money is coming out of the money that the corporation is earning. And so in this case, let's say they decide to put $2,000 per month because that's based on their historical extra income they have in the corp. The insurance rates, so the actual premiums, are going to depend on the insured person. The insured person has to be a shareholder of the company or a key employee, and it depends on their age and their gender and their smoking status and their health status. So in this example, just because these are numbers that I actually ran, the person was 42, a male. So if he continues these payments, if he continues the $2,000 per month until age 65, we estimate this very conservatively at a rate of return of 6%. The value of the fund inside the policy will be worth over $1 million at that time, and the death benefit will be worth almost $2 million. Okay, now the investment doesn't just stop growing at age 65, it continues to grow, which is really, really cool. Compounding growth is very fun to look at. So what do they do then? Well, let's say that the person decides to retire from active work. They can slowly draw down from that policy to fund retirement. So they might draw that down through withdrawals, or they might draw that down through loans. And in both cases, the amazing part about it is that there's still going to be a death benefit at the end of the day, right? And the death benefit forms part of the legacy. It creates a way to transfer corporate assets to any remaining family members. And those corporate assets transfer tax-free, which is a really key thing. I see your hand, Liz. I'm going to just try to get through like a couple more slides, and then I will answer some questions if that's okay. And feel free to write your question in the chat so that we don't lose it or you don't forget it. I just want to keep the content as concise as possible. And then, yeah, so just getting back to the access, if you borrow against the cash value in your policy, there are no tax implications to that. And what happens at death is that when that policy pays out, the amounts that have been borrowed from it, so any loans against it, will be paid first, and the remainder will go to the beneficiaries. If you take withdrawals out of the policy, there are some tax implications to that, and it depends on the nature, the size of the withdrawal, etc. But there would be some taxation on a withdrawal, no taxation on a borrowing. Either case, when you come to the time of pulling money out of this, you're going to assess what makes the most sense. And the death benefit is always going to be tax-free. And in this particular example, when I looked at the numbers, the policy at age 90 had a projected death benefit of over $5 million. That's with a 6% rate of return the whole time, which is very conservative. We could see much, much higher numbers potentially there. Okay, another option I'm quickly going to cover is what if we chose whole life instead? So whole life is, again, it's that sort of more guaranteed option, very, very low risk, like no risk. And we fund it with the same $2,000 per month. You can immediately borrow back $16,000 out of your cash value in that first year, because again, with whole life, you can access it to a high level. And then potentially you want to borrow that back and reinvest it somewhere else to continue growing all of your assets. You might invest it in real estate or something else. And this is essentially this is the infinite banking strategy in a nutshell. So how does it differ? Well, in whole life, you're going to see your cash value growing slower. However, you're going to have access to more of the cash value. So again, it's a choice to make. Sometimes, I know in some cases, in ours particularly, and others that I know, we have actually chosen to use both. We want both types of insurance because they both have some advantages that we like. So infinite banking, in a nutshell here, if you are not familiar, infinite banking is the idea of using a whole life policy, structuring it in such a way so that you create a high cash value in the policy, and then borrowing back your cash value to invest in other assets, and then using the income generated by those other assets to repay what you've borrowed, creating a cycle, hence why it's called infinite banking, because you're essentially getting your money working in multiple places at the same time. The coolest part about borrowing from your policy is that you haven't removed anything out of the actual fund. And so therefore you're still going to get the compounding growth on the full amount, even if you're borrowing and accessing and using that cash elsewhere. Okay, so if you hear about the infinite banking strategy, it is typically done with whole life rather than universal life. However, there are elements that are the same or that you can use in both cases. You can borrow from a universal life policy, it just works a little bit differently. Why would people use this strategy? Well, there's the key reasons why people get excited about this and why we got excited about it is because it does minimize taxation. We can't completely eliminate taxes, and I don't believe, it's fine. It's great that we do. We need to pay some taxes. I drive on roads. Whether or not we agree with how the government uses our money, that's a whole other conversation, but some taxes are probably going to be necessary, right? But if we can minimize taxation in some areas, that can certainly make a huge difference to what we get to, how we get to live our lives and the legacy we can leave for our kids. So the taxable events that can be mitigated through using life insurance is the tax on investment growth, right? So when we make money on our money, that's taxable typically. We can mitigate that. We can mitigate the taxes on accessing our money by using a borrowing strategy. And we can also mitigate taxes at death through the fact that a payout from life insurance is always tax-free. So there are 4 taxable events. When we make money, like our income taxes, the money that we earn, it's pretty hard to completely avoid that type of taxation, but we can mitigate 3 out of the 4 taxable events by utilizing this strategy. And then the borrowing power, especially if you're using whole life, is you have a guaranteed ability to borrow. You don't have to qualify for those loans, and it doesn't show up on your credit report. And then you're fully in control of the repayment of those loans, meaning you get to decide, how quickly you want to pay it back or slowly you want to pay it back. And that'll be very situation dependent. And then generational wealth, right? This is the power of life insurance is most times during an estate transfer, taxation is going to eat into a lot of those assets, right? Whether we're trying to get property to our next generation or savings, cash, investments, holding all of your wealth in an RSP is probably the worst place because it's fully taxable. But when we have life insurance and we've set these things up properly, we can transfer tax-free significant wealth to the next generation. Just a couple more slides, then we will open it up for some questions. So in what scenarios would infinite banking be a good strategy? Again, you can utilize this as a person. You don't have to be incorporated. You can have a whole life policy. You can borrow from your policy. You can do all of this as an individual. It's just that when you're incorporated, you can turbocharge it by using that 89-cent dollar, which is not available to the average person. So the number one thing is that you have to be insurable. You have to be able to get approved for insurance. If you can't get approved for a whole life or a universal life policy, that's obviously going to be a bit of a sticky point. You need to have available capital. So there's got to be some cash flow to fund this program, which means that you have some surplus cash in your business or your personal life. You can allocate some funds towards this. You also typically, this is best if you're a long-term investor because it's not like you do this and then 3 weeks later you're a millionaire, right? You need to steadily, slowly over time grow these investments. Incorporated business is very helpful. If you like the idea of creative financing and avoiding banks or being more independent of the banks, this is a great strategy for you. And if it's important for you to have that legacy piece and past generational wealth, this is a great strategy. I touched on this. Medically qualifying for insurance is necessary, and then cost of insurance is a factor. If you are, for some reason, very expensive to insure, then it can make a little trickier the numbers for this to make sense. But the younger you are, the healthier you are. If you're a non-smoker, if you're a female, this strategy can be more and more and more powerful because the cost of insurance is low and more of your cash can go into the investment. We can also get fancy and utilize some layering strategies in order to make sure you're paying the lowest possible cost of insurance and more of your money is going into the investment. And then it also gives you flexibility in the future to be able to potentially increase the amount that you're putting into that policy. So again, that's something you would address individually if you're going to look at this strategy. So in kind of final summing up here, if you are incorporated already and you have some cash flow and you're not sure what to do with it, this strategy might be a really great idea for you. You can use permanent life insurance to invest retained earnings inside your corporation and shelter that growth from taxation. You can also use the cash value inside your policy to leverage and buy additional assets, or leave it and don't touch it and simply use it to fund your retirement years. And the death benefit will form a big part of your legacy one day. So I hope that all landed, but I will open it up for questions. I'll check the chat in just one moment. Just want to leave you with this on the screen for a sec in case, people want to connect afterwards. So if you've been invited here by somebody other than myself, please reach out to them. If you heard about this from me, or you don't have anyone that you have been talking to, then the QR code here will just take you to my calendar booking link. You can book a free call. We'll just have a chat about your situation and see if this might work for you. My contact stuff is there on the screen as well. So let me pull up the chat here, and then I'll just see if there's some quick questions to answer before I stop the recording. Okay, if the business owner is the beneficiary, once passed away, the business owns a policy, how do the children get the cash value? Yes. Yeah, so very important question. The corporation is going to be the beneficiary of the policy. However, the payout of the life insurance goes into something called a CDA. It's an accounting term. It's essentially a nominal account inside the corp that allows money to flow tax-free out of the corp and to individuals. But it is really important if you own a corporation to have an up-to-date will and your corporate, bylaws or documents or whatever that is, so that if you do pass away, the people whom you want to get access to the corporate funds, right, the death benefit that's sitting there tax-free, make sure you have a will and you have the right documentation so that can happen smoothly. Yeah, Aubrey answered that. Great job, Aubrey. Yeah, the CDA, it's something accountants would know what that is, and they would be able to help with that. Okay. Liz, did you want to pop off mute and ask your question, or don't think I see it in the chat, but let me just scroll. Nope.
That was actually an accidental hand raise, but I do have a quick question.
Oh, okay, awesome. I'm gonna just stop my share and yeah, do you want to ask it on the recording or should I stop the recording?
It's fine with me.
Okay, go for it. I will be sending this out to everyone, so I just want to make sure you're okay to be on camera.
Sure. Is it straightforward to add a spouse as shareholder to the other spouse's corporation after the corporation is already open?
It depends. It depends on the type of corp that you have. We looked at this for myself and my husband, and it was not simple because he's a professional. His corporation was set up. He's a chiropractor, and essentially, I would have either needed to be a chiropractor or it was just going to be a very expensive operation to get me added onto his corporation. So I can't answer that. I think you need to consult your lawyer if you have a corporate lawyer. And look at the specifics of your corporation. Yeah.
Yeah, well, professional corps, that is very specific that you do have to be the same professional. So that makes sense.
And then you might want to set up a separate corp that's jointly, your joint shareholders on. You can flow things through. Again, I'm not a corporate lawyer or a corporate tax accountant, but you can flow money through from an active business corp into a holding company, and then a holding company maybe is jointly shareholder, yeah. Go ahead, Ofri.
So thank you, Amy. So what you said about my question, does the CDA will eliminate the money to go through um, probate?
Yeah, it can flow completely tax-free through the CDA, but you need to have a will. You need to have clear directions on, especially if the person to receive the funds isn't a shareholder of the company, right? Like if it was a husband and a wife or two partners that are both shareholders and one of them passes away, the other shareholder can easily access those funds. But if it's a child, or someone that's not an active shareholder, then you need to have all of that stipulated in your wills and legal documents. Yeah, I think I saw something else in the chat here. I'm gonna just stop the recording.